Hi, everyone. Welcome to the TimingResearch.com crowd forecast news for July 18th, 2022. We are recording this at 1 p.m. Eastern Time, and this is episode number 351. My name is David Kosmeter. I'm the creator of TimingResearch.com, and you should be seeing my screen right now, chart of the S&P 500. And today I have arranged for Wally Olopade, Michael Filighera, and Norman Hallett to join us as our guests, and the option professor is back to moderate. And also, I wanted to say that we have another big Synergy Traders event starting tomorrow, and all of the guests for today are going to be doing presentations on this event. And so the theme of this week's event is investing and long-term trading. So we're gonna have 30 presentations about that topic, and so a lot of good education. So be sure to join us on TimingResearch.com. It'll be 10 a.m. Eastern Time to 8 p.m. Eastern Time, Tuesday, Wednesday, and Thursday this week, July 19th, 20th, and 21st. And if you miss any, all of the archives will be on TimingResearch.com as soon as I can get them posted. So let's get started with the show. I'm going to go ahead and turn it over to the option professor.
Great. Okay, guys, great to be here. I got a nice big bounce in the last week or so in the stock market. Some people are saying the lows are in. Some people are saying it's a dead cat bounce. So let's talk about things today and find out where people are thinking it really is going to be going. We've got three fantastic guests here today, and they're going to introduce themselves right now. We're going to start out with Norm Hallett. Norm, a little background on yourself and what's going on at your company.
Well, I appreciate you having me, and I appreciate being the only last name today that can be pronounced on the first try. At least for me, but these are all great guys I've known for years, and I'm really glad to be on with Wally and Michael. My focus is the mental and emotional capabilities of traders. I'm at the disciplinetrader.com. I do offer a trading plan, a simple trading plan, because I think simplicity is hooks right in with with having a stronger conviction and ability to be disciplined. The more you got to focus on, the more you got to deal with, the less you're apt to stay disciplined. So that's my thing, and so I'm really a compliment to pretty much everybody else in the business, and so I'm really glad to be here. And when I comment on situations, it's really without much fanfare. I'm kind of an old school guy. Grew up like kind of as a tape reader, and I've kind of grown since then to really get into some of this technical trading. So again, glad to be here.
Yeah, Norm, I'll give you a good case in point. You know, the S&P bottomed at 3630, had a nice run up, came back down last week or so down to 3740. There was some long-term averages that came in at that point. And if you didn't have the psychological stuff bothering you, you would have had a better ability to buy on that support level with some confidence or with some kind of a discipline, because when the good buys and sell points hit, sometimes the emotions are just blinding the right thing to do. Don't you think?
Yeah, I think so too. And I think people make the mistake, even technicians make the mistake of looking around at the bonds and looking around at the at gold and some of the other things that they believe may be affected by inflation, which is affecting whether they buy or sell the stock market at the season. I think the more you trade, the more you learn. Don't look around. What you need to know is in the chart that you're looking at, and I think that's also can give you false signals or false senses of security.
You're trying to eliminate distractions and false crutches.
That is correct.
I got you. Yeah, no, believe me, that's very, very helpful. And I'm sure most every trader out there has had those feelings. So to control those feelings is a very important thing. Wally, a little introduction and what's going on at your company.
Yes, absolutely. Well, once again, thank you for having me on the call. It's always a fun to be here with you guys. My company is called Right Side Trading, and basically we named it that because the whole idea is to try to analyze what's going to happen on the right side of the chart rather than the left side, which is all in hindsight. And so we use technical analysis and quantitative analysis predominantly to help us determine what the market is saying. So I like to say we don't predict the future, but we can read what the charts are communicating. And that's the biggest thing that we do. So yes, so we took all that and all my research that I've done over the years. We studied seasonality, candlesticks, the whole 9 yard, and basically put it together in an algorithm format, which we now have on our software called the Right Side Platform, that allows us to kind of see what we need to be doing based on each and every day, whether we should be buying, selling, holding, or placing stops. Just 4 actions per day, 1 per day is all it is. So should we be placing stops? Should we be placing, buying stock? Should we be shorted? What should we do? Or should we just sit on the sidelines? And right now, for the bears, the same, place your stops on your bearish positions.
Sure. Okay. And Michael, background on yourself and what's going on at your company? Michael Filighera? David? Houston, do we have a problem?
Yeah, Michael, you're muted.
Mute. There you go. Thank you.
You sound much better when you're unmuted. I want you to know that.
Thank you very much. Well, it's just kind of funny because the screen normally comes up and I can just do it on the bottom, but suddenly I couldn't get the screen up correctly. Any case, my name is Michael Filighera. I am the owner, proprietor for TradersHelpingTraders.com and also LogicalSignals.com. And currently what's going on with me, like the 2 presenters along with me today, I tend to focus on the psychological aspects of trading, and I add that to what I already do in my presentations, which is I discuss the Elliott wave pattern and the Fibonacci sequences that go along with the movements that we're working our way through. Currently, I provide 2 video updates on YouTube, on my YouTube channel. And I'll give all that information later.
Sure. Perfect. Okay, guys, every Monday we start out with the question of the day, which is we opened today on S&P at 39, we opened at 38.83 on the S&P mini. So based on that opening, where are we going to be on Friday? Will we be higher? Will we be lower? Will we be about the same? Start out with Norm. What are you thinking?
I'm thinking we'll be lower, and I'm thinking we'll be lower because, and I'll give you the reasoning a little bit later, the more specifics on the chart. But I think that although we did get some bullish action, we had a nice hanging man on the bottom of a very short run, followed by a move higher, but not high enough according to some of the moving averages that I look at.
Yeah.
And of course, I think that every trader with that's been trading for a while knows that when you get a trend like we have, that it's very dangerous to call the turnarounds.
Right.
I just think that we are going to continue to have pressure on the market, and I right now I see this one-day rally as something that could peter out very quickly by tomorrow.
Yeah.
So I'm voting for a lower Friday.
Norm, no matter how much experience you have in the market, that discipline trader type stuff is definitely add-on value. For instance, today I've got a 36 SMA at 3903.44 on the S&P. The high today is 3902.44. Now I'm not short the market, but obviously I should be, because that's where it was supposed to stop, and that's where I was supposed to hit it, but I didn't do it. So the bottom line is, no matter how long you've been in the market, you're missing trades sometimes if you don't have the really good discipline. And just like a guy like LeBron James has a coach still going over his fundamentals. I'll never forget in the Super Bowl, John Elway is in the Super Bowl and Mike Shanahan's yelling, "Plant your feet." I mean, would you imagine a guy like John Elway would need to have a coach tell him to plant his feet? You know what I mean? But that's the kind of thing I think that the disciplined trader brings to guys, is that it either is a new information to them that's helpful, or it's a reminder information that's helpful.
Yeah, and just to show you a little bit about like minds, that moving average that I'm talking about is It's 34, not 30. You mentioned 36. I've been using 34.
Yeah.
And an EMA. So it's a little bit different, but it's reaching similar point there.
Same neighborhood.
Yeah, same trouble getting through. So I'd like to hear what some of the other guys think.
Oh yeah, no doubt about it. Wally, what are you thinking here as far as where we're going to be at Friday, 38.83?
So my first response would be lower. Okay, my first response would be lower, and that's because I haven't really seen a bottom being put in yet.
Right.
The data doesn't really show that, and I'm only basing that off of the bigger time frame, which is the weekly time frame. So the weekly time frame hasn't shown us that we put in a bottom yet. Okay.
Right.
However, it's realistic to expect some type of a relief rally, which is what I believe we're going through right now. And so my thing is this: if we can close above 39.45 any day this week, then we'll probably end up higher. If we close above that. Now that's the key level that I'm watching. It's like if we close above there, then we will close higher for the week. If not, then we'll start seeing things go a little bit further down. But my bet is to the downside. So I have short positions on, and even though the market is rallying like it is right now, I haven't closed any of those short positions simply because I'm expecting this to roll back down to the downside. And you guys mentioned moving averages. Moving averages I'm watching right now is a 50 SMA. And so right now, my thing is it's probably going to bounce off of that 50 SMA and then come rolling back down again.
Now, if we get above 39.50, that'll open up the 4,000 handles.
Oh, without a question. Without a question. I think it would. Even if it's for the short term, I think it would definitely open up that level. And one of the things, again, I talk about how we use seasonality, but you go back and you see the bear markets of 2008, the bear market of 2000, and it comes to a point where we get like a 1, 2, 3 month relief rally, and we are due for that right now. And so, and then seasonality wise, July is a month where the market tends to rally. So at the beginning of this year, I was telling my subscribers, I said, look, do not be surprised if we get the market rallying in July, because this is typically what we get in July. But it will be a relief rally, maybe to the end of July and then come back down. But that's how I'm seeing. But net, I'm still bearish on the market.
Yeah. And these relative strength indicators are having a heck of a time getting above 50. And that's another thing. Although, like Norm said, don't get distracted with 19 different things. It is an additive to the fact that it is still ultimately kind of a weak thing, right?
Correct. And you're absolutely correct about that. You know, RSI has been struggling, but again, the market has been struggling, right? I found it very interesting. Now, here's the interesting thing that I thought was unique last week. In a bear market, any bad news comes out, we expect the market to drop. Well, last week was a very great example. I remember hearing this early on when I first started trading. A guy told me, he said, look, if bad news comes out and the market rallies, that tells you something, that the institutions are bullish. And if good news comes out and the market drops, that tells you that they are bearish overall. So the inflation data comes out last week, Wednesday. It was bad. Market drops pre-market. And notice what happened for the rest of the day. It just kept on creeping back up. It refused to continue going down. And then the retail sales data comes out on Friday. It was good. Market took off. That tells me, hey, wait a second. What is it that these institutions are seeing that we don't see? It's like, it almost seems like they are not ready for the next leg to the downside. But that's why I'm also saying, okay, are they playing games with us where they're just kind of like repositioning things? And that's why I'm watching that 39.45, 39.50 level and say, okay, let's see what they do there. Because if they take that out, then that means that they are comfortable taking the market higher.
Right. And the frequency traders definitely like to go to the vulnerable side. After you drop down to 3,700, and there's all that volume, obviously, if it can start turning, there's no bids, there's no offers left. And so the high frequency guys, go in there and they press the offer side because they see there's nothing there to stop them. And boom, you go up to where you find some offers. So
absolutely.
It's really also a real merchandising operation, buying and selling, and basically on volume and size. You know what I mean? Yeah,
totally agree with that.
Michael, what do you got cooking as far as where we're going to be between now and Friday? And do you have any Fibonacci numbers that we can chew on?
I got one even better. I have an Elliott pattern. Excuse me. Wow, there goes the voice.
Yeah.
I have an Elliott pattern that's been active since June the 16th.
You want to share your screen?
Well, yeah, I can. If I can
'Cause
get
the
that.
imagination is nice, but it's always nice to have some
My
printed
problem
material.
right now, David, I cannot get over to the, yeah, it's just not getting me over there. Hold on. Let me see what this thing is doing, because there's got to be two screens here somewhere. And
Yeah.
I'm not
under
getting,
something.
I'm not getting the other one.
Over there.
Yeah, I know. There it is. Oh, finally.
Norm, you're a
Finally.
technician. Throw your Fibonacci's up there.
Oh, I got it. I got it. I'm just gonna have to put my other chart up there so I can show you what this is doing.
Mm-hmm.
So interesting, because it's not showing yet. You guys don't see my screen, or you?
I see a screen. Yeah, I see a screen.
Yeah.
Yeah.
Oh, beautiful, because I don't. Okay, so let me go to the daily chart here on the S&P, and I will, no, I said daily. Thank you
Yeah.
very much. And
There
you
you
will
go.
see right here, bing, bing. So there's the June 6th low, which was that great one that you talked about, Jim, 36.39, and it blasted right off of that. You're absolutely
Yes, it
correct.
did. Mhm.
And continued for the next day, blasting.
Mhm.
And so in a triangle pattern, I was actually expecting on an Elliott basis, a minor fourth wave correction. So once it started and it started to get real iffy, I thought, something's up and something's not right here in the market world. And it continues to be very cagey and very strange in terms of pattern. But if I had to go by what this pattern is telling me, it's going to be a mixed bag. And we have that possibility, as Wally stated, that possibility we're going to go up, we're going to test 39.40 to 39.50. And again, I do not disagree with the, if we get a close, and actually I would go as far as say it has to be a daily close above 39.50, it's going to put a very positive spin on at least a daily level for the rally to continue. But I think we got a lot of resistance in the way. So I think if I'm counting correctly, I have an A wave, an ABC B wave. This is the C wave, and it may have finished at this morning's highs, which would suggest we drop down in a D wave, which will show up as 3 coming down, but it's going to hold inside the channel lines. So, and it continues to wedge as we get closer and closer to its completion point. Now, the next one after that D would be an E wave, and that's going to be to the upside. So I balance this out with, like, we're expecting some big earnings this week.
Yeah. And next week.
And next week, even bigger.
Yeah, because 54% of S&P announces next week, 16% announces this week.
Right. And that would just be for the S&P. Now,
Right.
included in next week's 54% are Apple, are the big boys, our big tech titan companies. And that's why I think we're actually going to get a mixed bag. And I think that's going to be primarily based on the fact that this whole inflation cycle, this whole thing that's really stirred up a lot of this downside, is continuing to filter through. But now we're seeing it filter through all the corporations, and particularly on retail side, we got a hint of that last quarter from Amazon showing up with a loss versus blowing the doors off, which they'd done for 2 years.
Mm-hmm.
So here we are kind of getting the reverse, where all of our corporations are basically trying to now deal with, what do we do with these higher interest rates? And so, et cetera, et cetera. We're hearing, like, from Metaverse, they're cutting back on their hiring strategies. They're cutting back on what they're going to take on. They're cutting back on what they're going to pay people. We're seeing it also from Google. We're seeing it from Amazon. We're seeing it from Apple. Everybody's jumping on board of that to say this is how we'll survive, which I think is great. But it does also fuel what we can expect in terms of earnings. So I think it's going to be a mixed bag in terms of how things get reported and how that's going to be accepted or not accepted by the markets. So therefore, we get that back and forth activity, down, back up, we come back down, maybe today after some reports, who knows, we go back up in an E wave, and then bam, I think come next week, we get smacked with somebody doesn't come out with what people want to hear.
Yeah. You like
we-
the idea of holding the lows for a while and then basically oscillating between 39.50 and 37.85 or something like that?
At this point, I'm saying 39.22. I think if it gets to 39.50, it'll be a spike.
Right. Right.
And that kind of fits with what Norm's saying and also what Wally is saying is like we get up there, but it's rejected.
Yeah.
It's rejected, we turn. And the thing to keep in mind, if indeed this is a triangle pattern, the resolution of a triangle pattern, and this one is that a triangle will thrust out of the triangle upon completion in the direction of the trend. Well, I believe that the trend is down right now. So that would suggest that we're going to thrust lower out of the triangle. And
so you're not really thinking any kind of a 4,000 handles coming anytime soon?
Actually, no, I'm not.
Okay.
I do think we'll see it again, but not yet. I think that what we got to do is first we got to get down, and unfortunately, below that 3639 and likely below 3,500.
Okay.
Put in that low that Wally's looking for, that Norm's looking for, and then from there, I think is where we will launch in a more near to midterm size rally.
So broad strokes here, it looks like 3950 might very well hold this thing up. And then ultimately, you're looking for the lows to get tested, if not taken out, maybe in the next couple of months.
I actually am thinking it's going to happen faster than that.
Right.
And the rally will begin. Now, it could last until September, until we get this next rate hike.
Right.
You know, when all that's all done and said.
Yeah.
But I think from there, you know, towards definitely into year end, I don't see it as negative. I see it as they will be coming back in.
Yeah, well, because by September, we could have 2 more 75s, and that takes the Fed funds up to 3.25. 3.25 Fed funds is pretty healthy. And you probably see a pretty reasonable slowdown by then.
Gee, your middle name is not Paul Volcker.
Yeah, no, I mean, like I said, this thing is a lot of debt out there, and this is a much more vulnerable situation, much more leverage out there than there was with Paul Volcker. So you're just, and of course, on a percentage basis, you went from 0.5%. If you go up to 3.5%, that's a 7 times increase in the 10-year note yield. So on a percentage basis, the difference, and also it's happened in a very short time since March.
Right.
So you've had a very big percentage change, you know.
I was going to ask you, Jim, because this is where you do collect this information. Percentage wise on the raises that we've seen thus far versus what Volcker had to do walking into 1981. I don't remember exactly where it started.
Well, at the most he did what I think it started around 6 and he went to 15. So, you know, basically he did maybe 3 times. So 0.5% to where we are now, or where we're going possibly, could be as much as 7 times. So on a percentage basis, it's much more. And you know, we were at the all-time extension of valuations when this started. You know, we're up in the 23 area. So, you know, I don't think it takes as much wind to blow this sandcastle down as it did back in 1982. I mean, that's just my view. But anyway, hey, let's talk about this real quick because I find this to be very good information. On the Elliott wave, on the down, it's supposed to be 5 waves, so I can see that. Now, on the way up, isn't it supposed to be 3 waves?
Well, it's actually a triangle, so it's going to end up being 5. So, but I don't mean 5 in the terms that it's an impulse. It's an A, B, C, D, E, and they're all 3-wave patterns within them, and it'll wedge, which is what it's doing. So,
and your stochastics underneath staying under 50 also bodes for the negative as well, right?
Yeah, and that's just actually turned up because of the rally we had on Friday and then overnight.
Yeah, but up and under 50 are 2 different things, right?
Oh, definitely, yes.
And one last thing, can you throw any Fibonacci's up there that would give us some target?
Well, yeah, I can, but really what happens is that you got to run Fibonacci's in between. But what I did do is I put on some extensions if we got up that high. And actually, just let me correct this. Come on, just activate the extensions. Let me bring this back down to here. Come on, just put it. It's not going to be totally exact, but let's say that the top's at 39.44. Yeah. Here's what we got going on, Jim. This is the ultimate level I think that we get to, and that's just going to complete. See, all the corrective processes all the way down all start with an A, B, and a C. So I'm on an intermediate degree. We got the A, the B. I'm looking for the C. C waves are always 5 waves on this degree. So I've got 1, 2, and 3. This is 4. I got that 5th to come off. It should be quick. It should be fast. It should just get itself right to where it needs to be and then be done. and not labor. So I'm looking for this type of activity, a daily. I like 1, 2, 3, 4, 5 or 6 days of like pound, 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 and we're here.
Yeah,
We'll be there, and it just takes care of everything right off the bat, and it sets it up for a nice, healthy rally, rather than a rally that's kind of built on a hope, a whim, and a prayer that Apple and Google are going to still be the shining stars. So I would prefer to see it drop quick, and I think it could drop very quickly.
Yeah,
and then be done. And then we move into, what I would term as a primary degree B wave, because what we're completing is this next level up, that first leg down of its ABC correction.
mm-hmm.
And then that'll be completing that one more level up. So higher and higher and higher in terms of degrees, whereas this, for example, this cycle fifth wave, which ended there at our all-time highs, it began at the end of the 2009 on that debacle of all of that nonsense that came out, 2009, the economic collapse, blah, blah, blah.
Right.
That low to this high produced cycle wave 5. So in essence, what I'm really looking at is I think the first section of this next one down, primary, goes to that first retracement level, which is 382. So these outside retracements are of the entire rally off of the 2009 lows in the S&P. So, and that takes us from 667 up to 4,800. So 38%, yeah, that'll be a nice stop for completion of this intermediate degree ABC, set us up to do a nice B wave on a primary degree. And that actually would carry potential, depending on how it all goes out, that it could go up very similar to 2008 in the Dow, where the Dow all by itself went up to a new all-time high and then crashed. We could be setting ourselves up for the exact same thing because there's just so much noise about believing what we're in.
Yeah. If you just, if we didn't have any waves up there and you just put Fibonacci's up there and you use 4,808 as the top and 3,630 as the low, are there any Fibonacci numbers that could show up that would give us different levels of potential?
Well, I'll put it up there. Oh, I got to do it in the other chart. And yeah,
good question, Jim. It's always, when you're working with Elliott, you're working with ranges and momentums, and you're a guy that, hey, show me the point.
You show me a parameter and I can come up with a strategy.
Well,
if I know where the county lines are.
I do include the parameters.
Yeah.
But right now we're in a place where it's like, well, no, actually there aren't any, because I need to get this to complete. Then I got parameters, as I just showed you, right? The possibilities. Now here's this one, and that's these inside. So you're talking about, again, now that's that high to that low,
right? That
all holds and we continue to rally. Well, there's your 382. So that's a normal retracement. High to low would be 4,085, 86. And then you're really looking at 50% is not unusual. Now you're back at 42.23. A 618 is 43.61, et cetera. And if it turns out here, which it may, I may have to retract some of this, and that's the low, and we're going to do a much larger ABC. And if we're going to go to full bore, we are looking here or higher on a corrective bounce. Yeah. Not a new bull market, none of that noise, but on a corrective bounce. And please, I'm just going to toss this in. Don't forget, we want to talk about gold.
Oh yeah, no, we'll get to that. But this is good because, like I say, I don't know what everyone's opinion is, but my personal opinion is that we either hit a low at 3,600 and we're going to have a soft landing, or they're going to blow out 3,600 and maybe go down to 2,800, 3,200, and that means we're going to have a hard landing. So right now, if we're going to have a soft landing, there is.
There's potential for a very nice rally. But even if we have that hard landing, Jim,
yeah,
if it gets down there, look for that V bottom, because that's what's going to launch it. That's how we're going to.
I would imagine it would come with blowing out 3.5% on the 10-year, because right now 3.5% on the 10-year looks like it could be the peak. And if that's the peak, it would make some sense. Maybe 3,600 was the low. If you want to play it that way, if you want to play for that more severe landing, then obviously any of the stuff we're talking about here, might not make much sense to you.
A lot of it, you're right. And a lot of it's truly going to depend on what they're willing to do and what they have the guts to do in September.
Yeah, I mean, that unemployment rate is 3.6, and they want to get it into 4s. And to get into 4s, they're going to have to throw a lot more stuff in the road.
But if they do it,
stop
if
the
we
traffic,
get, it's like, if they had the ability to, when we had to do all the COVID shots, if they had the ability to give us the boosters all at once, but they couldn't because it would, we had to take it in shorter things.
Well,
So
yeah.
it's the same thing with interest rate.
Medicine.
Don't creep it up and see, because it's not working.
Yeah.
As far as I can say, the 50% aren't working.
Yeah.
Just smack it in the nose, get it to stop, get people to pull back.
Well, then again, they don't want to cause what they call an event and a liquidity crisis of some type, because again, they are very well aware how much debt is in the world. And so they are trying to, they have a balloon that's $9 trillion. And if you put a knife in the balloon, that thing is coming down very fast.
Well, can I ask a question?
If you prick it, hopefully it'll come down. So that's the whole theory, basically.
I hear you, but can I ask a question?
Yeah, sure.
If I were listening and you were telling me that, I would say, yep, you're right. But whose fault is all the debt?
Well, who cares whose fault it is? It is what it is,
It is what
it's a $9 trillion balloon.
So
and
they're
if you
trying
put a
to
knife
stop
in it,
their
it's
own
going to
problem.
fall fastly. And that's
So they're
the
trying to
whole
stop
idea.
their own problem that they may not be able to. That's my point.
Well, that's a definite, but we have to deal with what it is.
Yeah,
All right,
absolutely.
let's swing around and hear what's behind the curtain. In other words, what are you guys looking at that might be affecting the prices here in the near future? And Norm, do you have anything fundamental or technical that you're kind of looking at?
In the same market.
Well, in any market you'd like to
Yeah,
talk about.
I want to show my version of what's going on in the S&P. Can I share my screen here?
Sure, please.
Okay, let's see if I can do that in a respectable way. You know what I love about the markets? I love the fact that, whoops, see, I'm in a position I'm protecting right now, is that you can come pretty much to the same conclusion in many different ways. And I mean, when I coach somebody and we talk about Fibonacci, I have to make sure from a mental and emotional standpoint that somebody is not just using Fibonacci because they like Italian food. You want to use Fibonacci because you understand it's a universal truth, and that it's inescapable in many ways. And so that when you have 4 losers in a row, that you don't abandon your trading plan. Right. And you stick with something because you believe in the process of that built your trading plan. So I look at it. I'm looking at something a little bit different here. You see this right here. This formation is something that I look for. This is and it's really nice when you have a lack of conviction like you have in these spinners and dojis, and then a bold move. This is the 8 right here. EMA, a bold move through the 8 EMA. This is the 34. I use it as a guardrail. Although this is a trigger for me, I don't take that trigger because it's too close to the guardrail. And I always go with multiple positions, and I take a scalp before I let it run. And the reason I do that is so that I can eliminate the conflict in my head. Why didn't I let it run? Or and in the case where it ran and I took a scalp, or why didn't I take the scalp when it looked like it was going to run, came back, and now I have a loser where I should have just taken the low-hanging fruit. So I try to do both in a trade and make sure that I use my position sizing to keep within certain within your risk parameters. This is the same formation where you have indecision bar followed by a movement lower through the 34. Sometimes some of the guys that work this system with me, it's called loaded gun, and they wait for a confirmation. They'll wait for 2 closes below the 34 to believe it's actually turned. But look at this right here where it goes. This is a breakthrough with the same signal. This closed above the 8. You can see how it did well here. Here's another one here. Here's a losing position here. Although those that waited for confirmation to go up, here is a beautiful winner. When you see these averages come together and you bust through it, these are usually nice long. But you can see how, even though this is a reversal signal, the fact that we're, you look at how the 34 protects you from reversing and getting chopped up. Here's the recent, but more recently is the last signal. And this is a long signal to me, but we're right against the 34. And look at this, we've maintained this 34 EMA the whole way down to, to think that you're going to be the one that guesses it. Yeah, I'm seeing a double bottomish kind of thing here. I'm seeing no help from the RSI, but, until further notice, I'm short, and that's why I'm short. I look for lack of conviction, followed by a conviction, a still market, followed by a decision being made. I got this whole thing originally, this idea originally, still markets and then a decision being made, looking for the follow through and the momentum to start from looking at the trading floor and seeing these guys smoking cigarettes at the time. This was years ago, where they're doing nothing. You can always tell when the market's doing nothing. As soon as they're jumping up on the top step and they're waving their hands back and forth, something's going on. I can almost picture it when something like this happens. Anyway, this was the reason for my lower call. This is also, it looks like a double topish, in the short term. But I think that, the lines that I saw that were hard to see, that Michael just drew, this accumulation is, could take us out another week or two. So I think Michael probably I think he mentioned that, but I think it's going to be a little bit of a mess coming in here. But for the, until further notice, I think one has to look to the short side for, I use that in general to also to measure my exposure, my position sizing, which I think is the underutilized money management tool. And it can be used so well now with the micro mini futures contracts and so on. The idea of going, adjusting your exposure with the current flow. Anyway, I just wanted to show you the way I'm looking at the same market that comes with the same conclusions as Michael had.
Yeah, and that wick right now is starting to look a little, extended on the upside. So if we were to close down here or lower, would that candle be kind of telling us that today might have been a high point? Because you see,
yes, in
other words, if you get a pretty long wick, either under it or above it, is that indicative of maybe the next day it going the other way?
Yes.
It's amazing that you say wicks. I don't give wicks much attention.
Okay. Because they're pretty prominent. They look prominent sometimes.
Yeah, they do. And I was Steve Nissen I did a thing about 10 years ago down in Miami. He was one of the speakers that I put together, and he said to me one time that you see this right here, he says that when you see this, about 65-70% of the time, you'll see some sort of retracement, even with this kind of a movement, with this kind of long wick. So, I just, as far as I'm concerned, the way I trade, until we can break this 34 with any kind of conviction, you don't want to be in a market like this that does nothing. You want to be in opportunities. Yeah. So I like to watch for the triggers, and that's where the money's made, where the triggers, right. and you come to a new. Anyway, that's the way I'm looking at it.
I got it. Hey, Wally, can you put your screen up? We'd like to see your how you make your soup over there. What's in your soup?
Yeah, let me see. How can I share my screen?
And does anybody have what's that cloud called again? I don't use it, but it's a
Ichimoku.
Ichimoku. Every time I say that, Norm, I think of that steakhouse on Okeechobee Boulevard, the Okeechobee Steakhouse there. It kind of sounds like it a little bit, doesn't it, Norm?
It does. It does, but not quite as delicious.
Exactly. You've been to that one probably, haven't you? It's a great steakhouse.
Yes, I have.
Yeah.
All right. Can you guys see my screen?
Yes.
Okay, great. So let's put it this way. It's kind of interesting because I know David was talking about how this week we're talking about investing in long-term trades. And so one of the things I like to do, at least what I did, was I went to the quarterly chart of the S&P 500. And what I'm seeing here just tells me that the market is not going to recover before this year is over. And if anything, it reminds me very similar characteristics of what happened in 2008, 2000, 1929. is what we're seeing right now.
Yeah.
First and foremost is
I
this
see.
candle here, the
Wow.
quarter. This is the quarterly chart. And so we're looking at the quarterly chart
Uh-huh.
from January and well, at least the first quarter, January, February, March. And one of the first things is something I call the hilltop pattern, which is an outside date candle. Usually that's a topping pattern right before the market crashes, okay? And then when you have that followed by a confirmation of the next candle, which is the next quarter, which is what we have here, chances of this going down is very, very high, okay? In 2008, this was that same outside candle, which is called the hilltop. Two quarters later, we closed below that. We saw the market tumble over. Over here in 2000, we had that same outside candle. About 4 quarters later, it tumbled over. And so one of the things I did was I studied that, okay, when that happens, again, because, you know, I don't particularly pay attention to news. I don't care for news, to be honest. As a quantitative analyst, we study statistics, and that's kind of like what we do. We say, okay, how many times has this happened? What was the success rate? What was the failure rate? And based on that, we give ourselves a thumbs up or thumbs down as to what to expect. And so anything that happens more often than not, we say, okay, we'll just plan for it happening again. And then the other thing is, okay, what would tell us that something is wrong? What would tell us that, hey, this is not going to work out this time around? And then until we see those things, we treat it as what we've always seen in the past. Long story short, looking at this, the second quarter of 2022 confirmed that topping pattern that brought the bear market in 2008, brought the bear market in 2000, brought the bear market in 1929. And one of the biggest things I said to people, I said, look, when that happened, it took about 4 to 7 quarters before we actually hit a true bottom.
Right.
Okay. And if we're looking at that 4 to 7 quarters, that tells me like at least we have 2 more quarters in 2022. So I don't expect that to happen. Now, it's possible, like we had in 2000, where we had a quarter that seems like it's okay. You know, all these wicks right here were markets that seemed like they were pulling back. And I'm pretty sure when that was happening, people were like, oh, we bounced back. We almost going back to new all-time highs. But in essence, it really never did. It kind of tumbled over. And so that's kind of what I'm seeing. You can go back to, you know, this is the financial crisis. I mean, not the financial, 1929 Great Depression. Same thing, you know, it's not uncommon to have a quarter in between that makes it look like, hey, everything is back to normal again. Because you think about this one candle here is really 3 months. And in 3 months, imagine the market going up for 3 months straight. People would say, oh, it's over. Everything is back. We've hit the bottom. It's going back to all-time highs. But it's important that we don't get carried away by that, because what ends up happening is market kept on going back down. And again, this is that same hilltop pattern that we see here. 1, 2, 3, 4, 5, 6, 7, 8 quarters before we hit the bottom. I'm just looking at this and say, quantitative analysis wise, that's what we expected. And so,
Wally, what exactly is quantitative analysis in your definition?
So quantitative analysis is just going back in time and looking at data, statistics. Okay, so when this pattern appeared, what was the results? And so you look for certain patterns. And so in this case, we say, hey, in the bear markets that we've had, in multiple bear markets that we've had, how many times has this pattern appeared and what was the results? Okay, and so you just count it. It's like statistics in a sense. That's really what it is. And so you say, okay, if this happens, you know, it happened 10 times, and out of those 10 times, 8 times it did this when this pattern showed up, then that is quantitative analysis. And they say, okay, we are going to go based off of that. So seasonality is like a quantitative analysis, right? So if you say in the last 20 years, in the month of July, market has gone up 20 times in 20 years, that is quantitative analysis. So you trust that data because these are things that actually happen. It's not guessing, hoping, or wishing. These are facts.
Because history repeats itself.
Because history repeats itself. I mean, we are all humans. I mean, it's humans. I mean, even the high frequency trading, you know, Jim mentioned that, you know, hey, yes, it's high frequency trading, but it's still people behind it. And they are programming these high frequencies to do something based on the way they think. So everything is behavior. That's just what it is. It's behavior. If I go out there every morning and I drive 1 mile to go get my cup of coffee every single day before I go to work, that is quantitative analysis. Right. So it's just a matter of kind of like saying, hey, this happens over and over. And so you can track my GPS and you can say, hey, wait a second. And then if you see me, rather than going to Dunkin' Donuts to get my coffee, I go to Starbucks. You say, whoa, wait a minute. That's not.
I mean, yeah,
normal.
I better go short.
Exactly. I better go short. That's not normal because he usually goes to Dunkin' Donuts every single morning. So what is going on? So that's what that is. So we study a lot of statistics, a lot of data, and just, okay, this has happened 10 times out of 10. This has happened 9 times out of 10. This has happened 8 times out of 10. We're willing to take that chance. And then it said, what is the thing that would tell us, hey, wait a second, this is not really acting the way it's supposed to act. All right. Then you kind of figure that out too as well. And then you go forward. But right now, once we have this and you have another red candle that confirms that, then it's I mean, you can go back to even the 1973 grade, bear markets that we had on all kinds of, it's the same thing. You know, when this happened, 1, 2, 3, 4 before we hit bottom. You go back to study
73. That's before Jim was born.
That was
exactly 2 days before. Yeah.
Interesting. So it's just things that you see when I study bear markets, and it's not hard. It's just looking at statistics and saying, hey, this has happened. Okay, now that we know this information, just expect the same thing. Now, could it change? Yes, but we don't go off of could it. We go off of this is what has happened, so we're gonna do the same thing again.
Mm-hmm.
So yeah, I see this now, and I say, even if the market, right, unless we take out the high of last quarter, which would be somewhere around, let's see here, that would be, what's this high right here? This is 45.93. Unless we take that high out, then all it is still just a relief rally until the next drop begins. It's really what it comes down to. And then you ask, how low can it go? So now that's the one thing we don't know. How low can it go? But what we do know is that in the past, when this has occurred, 4 to 7 quarters is what we're looking at. So if that's the case, then that puts us to what? June, July of 2023, and maybe even March of 2024.
So how does a short-term trader, Wally, use your stuff? I mean, because there's a lot of possibilities, but in a wide range.
Very good. Yeah, very good. So 2 things. One is, if you know that the overall market is bearish, which is what we're doing, so we know that the overall market is bearish, then you wait every single month. There comes a time when the market is ready to roll over. And so you wait for that opportunity to occur. All right. So right now, say we go to the daily chart. Looking at this daily chart right now, market is rallying. Fine. Okay. But you start seeing 2 red candles back to back, chances are it's ready to roll over for the month of July. Mm-hmm. Okay. And then that's when you start shorting.
What do you think? What do you think of that gap there that comes at around 40.20 and 39.75?
You talking about this right here?
Yeah. Do you think they might want to go after that? Is it possible that they take out the 39.50? They run it into that gap near the 38% Fibonacci, which is 40.85.
So my thing is, I doubt that that's going to happen. And the only reason why is because you guys are talking about moving averages. If you put on the 50 SMA, let me see if I can.
Yeah, where's the 50 SMA?
Let me see if I can put that on. If you put on the 50 SMA, it's below that level. So I seriously doubt it's going to pass that level.
And we didn't, on that last rally at Memorial Day, it did get above some averages, but then it actually went in the tank soon afterwards. So
exactly.
I was just wondering if it might get above that average for just a very short period of time and then go back into the tank, because the direction of the blue line won't really change. And they'll be able to get those stops and everybody else up there. And then
kind of similar to what you see right here, what happened in March is what you're saying. Yeah,
exactly. Similarly, yeah. I mean, similar. I mean, it could. That's what I'm trying to say. That would be a risk. Yeah.
Yeah, that would be. So now that would be abnormal. Okay, so if that was to happen, then I'll say, okay, yeah, all right. Truthfully speaking, I'll say, okay, we need to start paying attention to maybe the market might start rallying and go even higher. So the next question would be, where would be the next support? So then at that point, I would say maybe this level up here would be what we'll be expecting it to do. Is go up to that level at that time, okay, before it rolls over. Because, and here's the thing, the reason why I say that is because in a bear market, or at least in any trend, we all know the definition of trends: higher highs, higher lows. Definition of a downtrend is lower highs, lower lows. So if we were to trace this, I wish I could trace this. If we were to trace this, then we say lower highs, lower low, lower highs, lower low. However we want to do this, lower highs, lower lows, and then we have this, and then we have this, right? So first of all, we have to take out this low. And then if we take out, this high, if we take out that high, fine, then the next high I will be expecting I wouldn't even worry about anything in between. I said, look, can we take out this high? Because if we do, then we have an issue. But the moving average is a big barrier
Yep.
along the way. And
Oh,
that's
yeah. But it can be violated and then obviously
Yeah.
come back into play. And that's the risk at this point. 39.27, you think is a pretty key number. You start closing above that, it might open the door to filling that gap.
correct. And that's why I said earlier today, I said, look, if we close above certain levels, then, it's breaking those barriers. But, we have to look at it and say, hey, here's the barriers. And until that happens, we got to trade what we see. So I'm saying I'm aware. I'm definitely aware of those levels like you're talking about.
Yeah.
And my thinking is like, okay, until that happens, then let's wait and see what happens. But in my case, it's like, okay, the first barrier we have to like worry about is this 50 SMA, which is what is bound, or the 34 EMA, like Norman said earlier. I think it was Norman that said it, 34 EMA. And right now, that's literally where it's bouncing off of right now. So I said, okay, you know what? We have to deal with this at first. Until that level gets broken, I'm not worried about it. Now, are we shorting? We've held onto our short position simply because of the longer term, most of the bigger time frames that we're looking at. So like, let's say if I go here to the monthly chart, if you look at the monthly chart, nothing's really changed. Let me clear everything out here. Nothing's really changed. I mean, if you take away the daily and just look at the monthly and say, you know what, until we take out this month high, then we technically still in a lower high, lower lows kind of situation.
Oh, no, there's no doubt about that. The question is are we going to try to, run some of these stops, get these people out of their short positions, which is what they're trying to do.
Yeah.
The other thing is since I'm an option person, the VIX has no interest in getting above 30 lately. And as a matter of fact, it's in the 24s. It seems like if we start seeing a print of 23 or 22, it would confirm we're going after those higher prices.
So very good point, because I actually saw that too on the VIX. I said, wow, I would have expected the VIX to take off, right? And the VIX is not. The VIX is actually going lower. And I was like, okay,
right.
Well, if the VIX is going lower, so does that mean that the fear gauge is telling us that they are confident putting money back into the market?
Right.
So we are watching that too. It's like, because I would have expected at this stage, I would have expected VIX to be taking off like it did back in June, or like how it did in April. And it's not. And so
now, but you're getting some comfort now because there's a 25 print up there. But I'm thinking if you see a 23, 22, they're definitely going after those higher prices.
Oh, yes, without a question. I would definitely say so. Definitely, especially because, you have this level right here. So if it takes this out, then they're going after those higher prices. So those are just levels we watch and say, hey, if that happens, we need to be aware.
Okay, well, there's 5 minutos left for all you Spanish-speaking people out there. That means 5 minutes. So let's go around the horn and reintroduce ourselves and tell people how they can get a hold of you. And if you have any special offers, great time to announce them. Starting out with Norm. Norman Hallett.
Sorry. I just looked. The woman on CNBC is giving birth right now.
Oh,
I'm watching it live.
It's not Rosemary's Baby, though, isn't it?
Yeah, no, not it. But she's amazing, isn't she, on CNBC? I know we're not supposed to be watching that. I do want to say that I haven't given up looking at the precious metals.
Oh, right.
Anybody in commodity, anybody that grew up in the commodity futures business like I did years ago, and has loved it ever since, always has one eye on the precious metals. And of course, this is the environment that one needs to pay attention. Now, it's been, maybe it's baby with the bathwater, maybe it's, whatever it is, we have not seen what everybody expects as far as seeing some upward movement because of this inflation that was once anticipated and now is on top of us. When is this going to, is it any longer a store of balance between for inflation? And the answer is it still is, but I think most people don't realize that it usually happens more after the fact than you would think.
Right.
My only statement is that, and I usually prefer silver over gold, and most active traders seem to do that. It seems to move with a little bit more gumption. I'm looking for that bottoming action, and I'm looking to get into that for a nice, few month type run. Hasn't happened yet. And, I think a guy like Michael and the way you look at, the waves, that really could help me. I should probably have a conversation with you offline, and Michael, about that. But the idea is that I'm looking at at spots to enter into the gold and silver markets. As far as I'm concerned, again, I concentrate on the mental and emotional issues of trading. If you want to see what I do as far as combining that with a trading plan, I've written several books on trading, building trading plans. You can go to simpletradingplans.com. And what you'll see is a little bit more on what I've described here earlier as our loaded gun process. But I've really, really enjoyed Wally and Michael. And you let us talk with some length today, Jim. That was great.
You know, we got to mix it up here to keep these people coming back for this stuff. You know,
That was good. You let them complete the thoughts. I really enjoyed it.
All right, Michael, if you in a minute or so can throw up a chart on the gold and give a 1 minute presentation, at least a cliff note on it, that would be helpful. And then we can try to keep the overtime.
As soon as whoever's got it now relinquishes it, I will put it back.
Here you go. It's here we go.
You're able to now.
Yeah.
Oh, there I am.
It was something you wanted to get to, and believe me, it is very important because it's either 1400 here we come, or we're looking at the lows probably.
All right, now, oh, actually, I did that wrong. Hold on. Got to get to the right screen.
Starts with a G.
Yeah, you're right. Come on, please do it quickly. Share this one. Yes. Now, do you see my screen now?
Oh, we're there. Let's go.
All right.
Oh, does that say gold? No, that says NASDAQ.
No, that's NASDAQ, which, by the way, we are making new lows and we're down on the day. So,
Steady.
yeah.
Norm, where were you, Norm? I wanted to short at 39.03.
I was putting my order in.
Yeah.
All right, so gold, I need to take this out to the weekly chart. Jim, I think you're going to really like this. I have been waiting for gold to make this move. And Norman, I am the gold bug from 1980.
From Harry Schultz. Yeah.
Oh, yeah, I've been following gold for a very, very long time. But here I'm going to tell you, I've got it all set up. This is where I'm looking for this market to drop down to. And I think that that's a major, this is off a weekly chart. I think it's a major low, and it sets up that this is an intermediate fourth wave correction complete. We move into a fifth wave up within a larger pattern, which is also pointing higher. Thing to remember in a commodity, particularly in a precious metal, particularly in gold, it is not on an Elliott basis. It's not the third wave that's normally the longest and the strongest. It's the fifth wave.
Wow.
So no matter where you are and no matter what degree you're doing, that fifth wave should have the same characteristics, the same personality, and it should blow the doors off. Now, Jim, you may have gotten some wind and all this, but we know that there's somebody out there who's holding on to such a short position in gold that absolutely will defy gravity to try to keep it lower because it'll blow them out. And that's talking about a too big to fail player that's out there because they're involved with GLD and SLV and the promises that they're now trying to relabel and not a guarantee that we're holding gold in your name.
I got you. So stuff like that. Now, getting to the numbers here, you're looking at 1650 to 1662 as basically that's as bad as it gets. But if it does break that dam, do you see where I'm getting my 1405 from?
I do see where you're getting that 1405, but I think I do.
Well, I mean, let's hope. Obviously, if you're bullish, let's hope the 1660, 1650
well, yeah,
works out.
Well, not only that, but I get if it breaks below 1653, but I wouldn't automatically attach 1405 because I do also understand that they're out there talking about major collapse in gold.
Now, what about on the upside? Would you feel more confident above 1715, 1730 to get on the train?
Start getting long?
Yeah.
In
other words, I mean, at 1740, you'd have some evidence maybe that it's going back up.
Absolutely. Yeah. Now, my other point is that I think that's going to go so fast, it's going to blow the doors off of everybody. It's going to go so fast that the short squeeze will have taken hold, and whomever's going to get blown out is going to be too late.
All right, Michael, get a quick thing on how do people get a hold of you, and then I got to get to Wally before David says
right before David cuts us all off.
Yeah, right.
Again, you can get a hold of me. I'm Michael at MJF1partners.com. That's my email address. Norman, please use it. I'd be more than happy to sit down and have a talk, get on a show together. I don't care. Also, thank you very much for having me today. But the other thing that I do as well is I provide a video update on both the S&P and the NASDAQ each and every day, where I review the Elliott, I review the Fibonacci's, I review what's going on in the world. And I talk about that, and that's on my YouTube channel. And that YouTube channel is TradersHelpingTraders.com, and Traders Helping Traders on YouTube, but also connected to my name.
Okay, perfect. Wally, can a little information on getting a hold of you, and of course, Right Side Trading. What can we get?
Correct. RightSideTrading.com. Right Side Trading, just think about the right side of the chart. RightSideTrading.com is who we are. I write a weekly newsletter every week where I go into details about what's going on in the 5 major indices, the SPX, NASDAQ, the Dow, the Russell, and the Dow Transportation, which gives us a good idea of what to expect. And then we touch on some stocks that we also see are doing well or not. But you can always reach out to us, RightSideTrading.com.
Okay, perfect. As far as Option Professor is concerned, you go to optionprofessor.com and you can get our PDF report on how to hedge downside risk as well as upside surprises in the stock market with limited risk situations. Optionprofessor.com. You put your information in there and you can get the PDF report. Okay, David, 3 minutes is not too bad of overtime. Thank you guys for being here, Norman and Wally and
Thank you,
Michael. Yep, and
I'm guys this week as well. I'll be on the call tomorrow.
Okay, and David, back to you.
Yeah, a ton of good info today. So for everyone listening, if you want to hear more from these guys, be sure to join us for the investing and long-term trading event that will be starting Tuesday morning at 10 a.m. Eastern time. And we're going to do 10 presentations each day. So 10 a.m. Eastern time until 8 p.m. Eastern time, Tuesday, Wednesday, and Thursday, July 19th, 20th, and 21st. So, and you can just come to TimingResearch.com to get access to the event for all 3 of those days. There'll be a link on basically every page to access the room. So be sure to join us for that. And also for today's show, be sure to subscribe to Timing Research and YouTube, the Timing Research YouTube channel, and Timing Research on your favorite podcast app to get the recording for today and all the other recordings. Also, that will be on TimingResearch.com as well as soon as I can get it posted. So just want to thank my guests again for today. Wally Olopade of RightSideTrading.com, Michael Filighera of LogicalSignals.com, Norman Hallett of TheDisciplinedTrader.com, and the Option Professor of OptionProfessor.com. Thanks, everyone.
Thank you.
Bye, guys.